Hi everyone. My name is Arturo Jesus, and today I'll be going over my CAPM and cost of equity analysis using the driver framework. So the goal of the project is to find the cost of equity, for three companies using the capital asset pricing model, or CAPM for short. This helps investors understand how much return they should expect for taking on risk. So the CAPM formula is required return equals risk minus free rate plus beta and then times the market risk premium. So here's what each part means. So the risk-free rate is what you'd earn um, from a safe investment like US Treasury bonds. Beta shows how risky the company is compared to the market. And then the market risk premium is the extra return investors expect for taking on market risk. So for the represent aspect, so let's start with the information we're given. So risk-free rate is at 4.5%, market risk premiums at 6%, and then expected market returns at 10.5%. So now here are the companies that were given. So Cloud Tech, Regional Bank Corp, and Green Energy Utilities. So for Cloud Tech, it was at 1.8 for beta. It's just a tech industry, tech startup. And the description is high growth and very risky. Regional Bank Corp was zero point 0.9 for beta, just industry of baking, and then mature and steady growth. And then Green Energy Utilities at zero point 0.5. The industry is the utility, and then it's very stable and then low risk. So based on their betas, Cloud Tech is the riskiest and green energy is the safest. Now I will show this all at the end of the video to share my screen. So now let's calculate the cost of equity for each company. So Cloud Tech at 4.5 plus the 1.8 and then times the 6%, it came out to about 15.3. Regional Bank was at 9.9% and the Green Tech Utilities was at 7.5%. So we can see that higher risk means higher expected return. And then Caltech needs to offer investors around 50% to attract them, while green energy only needs about 7.5%. So if we graph this on a security market line, it would be a straight line going upward, showing how return increases with risk or beta. And validating now. So now let's make sure our results make sense. So the market average return is 10.5%. So companies with betas above one should have returns above 10.5%. And those with betas below one should have returns below 10.5%. So that's exactly what our results show. So our math does check out. And then going on to the evolve factor here. So let's look at these numbers and what they mean in real life. So why do these betas differ? So CloudTech is a startup, so its stock prices move more sharply with the market. Regional bank is affected by interest rates, but still they're fairly stable. And then green energy is a utility, which is very safe because people always need electricity. Um, and then how could cloud tech lower its cost of equity? They could build a steady cash flow instead of chasing fast growth. They can form partnerships with stable companies and communicate clearly with investors to build trust. And they can also mix in some debt financing to balance their capital structure. Um, so just going off of that, so what happens in a recession? So if the economy slows down, investors demand more return for risk, meaning the cost of equity goes up. So cloud tech's rate might rise to around 70%, while green energy might only go up a little. That's why it's safer for companies to tend to do better during recessions. And just reflecting on this overall, this project helped me understand how CAPM connects risk and return in a simple way. Um, Even though the formula is short, it explains a lot about how investors think. I also learned that CAPM isn't perfect. It assumes the market is the only source of risk, but in real life, there are other factors too. That's why analysts sometimes use models like the dividend discount model or FAMA French models to go and get a deeper view of it. But still, CAPM gives a clear starting point for comparing companies and deciding where to invest. So in short, CAPM shows that the higher the risk, the higher the expected return. The key for companies like cloud tech is to manage that risk, build stability, and keep investors confident, because that's how they can lower their cost of capital and grow successfully. So now I will share my screen, show my calculations. Um, so here we have just our quick recap table. These were I pulled off from Python, just based off of the code. So cloud tech, regional, free energy, high, moderate, low, low because the utility. Um, and then we can go to the calculations as well. Right here, implementing them. So at 4.5 for all of them, then the point 0.5, point 0.9, 1.8 betas, and 6% each. You can see Cloud Tech 50.3% is the highest out of all of them. And that was my video, and I hope you enjoyed it.